So we had the conversation this morning whether a good number would actually be good news for this equity market. I sense from what you're saying it would be.
We'll see about that. I actually think we're back in this kind of like perverse environment where bad news is good news.
We flipped again.
I think we flipped again because when you look at what's going on, I mean, this is like it's unhinged, right? So the market right now, the market right now is calling for what 125 basis points of cumulative easing this year, so another 75 basis points after what the Fed has already delivered back in September. And when John, you mentioned earlier some commentary from the chairman that they're not in any rush. There's no real worry. I mean, how do you adjust the dot plot from 25 basis points to 100 basis points of easing over the course of 3 months, and then add another cut to the cycle by the end of 2026 and say, hey, we're not worried about anything? That to me is telling, very telling about how the Fed in particular thinks about what's going on with labor. And what's even crazier to me is that in the aftermath of that June summary of economic projections, right, the Fed tells us 25 basis points. The market says you're full of it. It's going to be 100. Then the Fed comes out and says, okay, you're right. It's going to be 100. And the market says, no. It's actually going to now be 125 or 150. If we see payroll gains come in tomorrow at 150,000, if we see the unemployment rate stabilize at 4.2 or even move a little bit lower, I think that narrative for 125 basis points of easing continues to deteriorate. And when we talk about inevitabilities here, John, I don't know about an inevitability with layoffs, but at some point, this game of chicken between the market and the Fed is going to come to a head. At some point, somebody's going to be right on this one. And my guess is the 100 basis points is probably closer to the truth than the 125. And as soon as markets come on board with that, you got volatility all along the curve. You got volatility in the equity market.
So just let's stay with the whole idea of now good news is bad news for equities in particular. That's basically what you're saying, right? That basically you start pricing out interest rate cuts that are outsized. That is going to be risk off. Okay. I guess I'm trying to wrap my head around something when really everyone was telling us that if companies are in a good economic situation, that is good for these companies. If inflation is a little bit hotter, that is good for corporate earnings. Doesn't it all come down to corporate earnings more than anything else, and we're just basically rearranging the deck chairs ahead of earnings season?
Without a doubt. I mean, it's earnings, and in particular what's going on with margins. And I think the differentiator in this conversation has to be the market versus pockets of the market, right? We know that the market, by and large, has been driven by a very small handful of names. That story has changed a little bit in recent months. But generally speaking, driven by a very small handful of names, gassed up on this idea that, AI is going to fundamentally transform the world, lofty valuations, pretty impressive earnings expectations, but the S&P 493 or whatever it is that you want to call them are much more fairly valued. And so I think if we're looking at the market in aggregate and we're worried about valuations in aggregate, then this change in expectations around interest rates may put a little bit of downward pressure on the overall entity of the S&P 500. But that doesn't mean that the rotation that we've been seeing in the market is not durable, because exactly to your point, Lisa, the overall macro trends I think are actually quite supportive. You have cooling wage pressure, which is good news for corporate America. You have easing inflation. I would agree we're not completely out of the woods just yet, but I think with inflation stabilizing, that's good news. And we have falling interest rates. And if that's 100 basis points or 50 basis points, anything's better than 0 basis points. And that's all good for a broadening out, I would say, of profitability.